Good morning, everybody. Hope the week is treating you extremely well. We're going to take a look at the four major U.S. indexes in today's video. We're also going to jump in and take a look at what's going on in the emerging markets as well. But I first want to jump in and really analyze the S&P 500 chart for you. And I want to talk about moving averages as we're now back above the 200-day moving average on the S&P 500. And you're probably going to see a lot of information about that in the financial news media here over the next couple of weeks if we stay above it. Let's go back in time a little bit here. On my chart, I've got four moving averages. The 10-day moving average is the white line. The 20-day moving average is the yellow. The 50-day is the blue, and the 200 is the purple. Now, when everything is lined up, meaning the 10 is above the 20, which is above the 50, which is above the 200, and price is above that, right? That's what we've got back in here. You can see the 10 is above the 20, it's above the 50, it's above the 200, right? Things are good in the market. Things continue to move forward. All of the moving averages are lined up together. Price is moving in that direction. Trading is very easy. Follow the trend. The trend is clearly up, and that's what those moving averages tell us. Now, when things get messy is when moving averages are telling us different stories. So at the beginning of last year, price fell below the 10, below the 20, below the 50, but they were still above the 200. And the moving averages themselves, you can see them all crossing around in here. It makes for a giant mess, right? About 3 months later, we get the 10 back over the 20, back over the 50, back over the 200, back in here. And what does the market do? It runs up for quite some time. All right? The end of last year, we then got the exact inverse signal. The 200 was above the 50, which was above the 200, which was above the 10, and price was below all of those. And that's really where we saw that massive push to the downside, because it's the exact inverse, right? All of the moving averages are aligned in a bearish fashion, price being underneath of them, and we subsequently get a sell off. Now, we're almost back to the point where we have all of the moving averages lined up and going the same direction again. All right, the 10, the 20, the 50, price is above that. They're all lined up properly. The 200 is above all of them, though. So what we would need to see in order for things to be all clear on the moving average signal would be the 10 to be up here, the 20 to be up here, the 50 to be up here, and that 200 to be below those. And that could happen in the next month or so if price continues to drift higher. Then we would have that alignment of all of the moving averages, and that subsequently would be bullish. So what we have right now is we have what's beginning to look like the setup that we had towards the middle of last year, where everything could get realigned again after a period of choppiness and a period of selling off. The market restabilizes itself, and we can get that push to the upside. Now, when we talk about the moving averages, that's one part of the picture. The other area that's extremely, extremely important to pay attention to is those areas of resistance and support, and that's what we really talk about in these videos. There is a major level of resistance that is right here. Yes, the S&P 500 recaptured the 200-day moving average today. That is a good thing on a technical analysis side of things, but it's not the complete picture. We have three sharp selling events that happen right around that 2800 on the S&P 500, right? Last year we tried to make a bounce once, failed. Tried to make a bounce twice, failed. Tried to make a bounce the third time, and that's where we really went and had quite the sell-off there into the end of the year. Now we have had a pretty much straight up rally right into that zone we're approaching right now of resistance, right? It would be very bizarre for us to just keep moving absolutely straight up and never have any sort of a pullback. All right. Usually, when you run up into a zone of resistance, even if you're ultimately going to break through it, usually you are going to fail once, make a pullback, regroup, and then if you're going to make the break, it happens on the second push or sometimes the third push. Very rarely, especially after such a move straight up, are you just going to break directly through that. Can it happen? Absolutely. Is that the highest probability occurrence from right here? Probably not. We are approaching, at this point in time, RSI nearing that 70 level, that overbought reading. What would make a lot of sense from a technical analysis side is if we got above into that 70 zone, we got somewhere up right around that 2800 number, and that ended up acting as a short-term ceiling. We pulled back, the market regrouped essentially, and then made that next push. That would be what makes the most amount of sense based on how all the technicals are currently set up at the moment. Again, can we just go straight up? Absolutely. But we do have major resistance, and that is where we are approaching. So while everything seems great, you're going to see a lot of financial headlines. We're above a 200-day moving average. Things look really good. Remember, we still have this major zone of resistance to get over, and I would argue that that zone of resistance is more important in this particular instance than the 200-day moving average itself. So let's check in with the rest of the indexes, right? If we take a look at the Dow Jones, we're actually back above the 200-day moving average for a little over a week, all right? We made the break over. We back tested the 200-day moving average and continue to push forward. But the same area of resistance, right? It's a little bit less clean than the S&P 500. The S&P 500 was very clear, that 2800 level. This we made a fail here, a fail here, and a fail here. So this almost put a head and shoulders topping pattern in, whereas the S&P 500 put in a triple top at the end of last year. Same thing though. We've got that major resistance level that we have to pay attention to right here. All right. So we're above the 200-day moving average. All the other moving averages are aligning themselves up correctly. In fact, the 10 is over the 200. So you can see the difference. You know, it spent more time over the 200-day moving average, and subsequently the other moving averages have had a chance to continue to push up. And the 10 moving average, as you can see right here, is actually above the 200. All right. So the Dow leading in terms of getting over the 200-day moving average first. The NASDAQ. Right on the 200-day moving average as we speak right now. It's not above it. It's not. It's literally right there on that 200-day moving average. So it is trying to make that break. Now, it had a little bit of a different charting setup last year than the S&P 500 or the Dow. This made a set of lower highs, right? So we had a head and shoulders. We had a triple top. And in this particular case, we just straight up had a downward channel, right? So the zone of resistance on the NASDAQ looks a little bit different. Because really, we just need to take out this high. If we take this high out, then technically we have a high, a low, and then we would end up having a higher high. That would negate the downtrend that's been in place, but it is going to have trouble, right? The whole zone of resistance goes up to about that 7,300 number. Now we look at the Russell, right? The Russell, weakest last year, well below its 200-day moving average, a lot earlier than the rest of the indexes, sold off much further than the others, not even back to its 200-day moving average. And here's the interesting thing with the Russell. The 200-day moving average actually acts as that resistance zone. So the rest of them, that 200-day moving average would maybe be the equivalent to back down in here, but since the Russell is so good, so far below it, where we sold off from was actually below the 200-day moving average, and it hasn't come up and tested its 200-day moving average since October of last year. All the other indexes a lot earlier than that. So when we look at the four major U.S. indexes, while we have had an amazing run up here at the beginning of this year, we've recaptured the 200-day moving average on some of them. We don't have all of the moving averages aligned properly still. And more importantly, we've got these major zones of resistance that we are now approaching. So things should get a little bit more difficult here over the next couple of weeks until the market ultimately makes that final decision of whether or not this resistance zone that's right here is going to continue to act as resistance, or if we're going to break through it and we're going to have the opportunity to make new all-time highs here this year. We jump in and we take a look at the emerging markets. The emerging markets have recaptured their 200-day moving average as well, right? Have recaptured their 200-day moving average, very similar to the rest of the U.S. indexes, where it is above those prices, but we do not have the 10, the 20, the 50, and the 200 lined up just yet, right? If we continue to kind of drift higher here over the next month or so, those moving averages should realign themselves, and we should get that technical signal that things are kind of in the all clear. With this, the real zone of resistance that's in on The emerging markets is right in here, so we still have a little ways to push up into it. That's where that major price action happened last year. That's where ultimately that major breakdown occurred from testing of the underside. And so really it's that 1100 to that 1150 zone on the emerging markets where we have that major resistance. So there's still ways that this can run before it hits that major resistance zone. I hope you guys found this video helpful this week. Let's continue to pay attention, see if we can get those moving averages to align themselves properly here over the next couple of weeks. And let's really pay attention to what happens here in this major resistance zone across all those indexes, because we are certainly at the battleground at this moment in time. Have a great day. Take care.